What do I mean by a natural person? Natural person is somebody. Natural person is somebody who can be a customer of the organization, who can be supplier. He's a natural person who is in transaction, who's carrying out a transaction with the business. So he can be a customer, he can be a supplier. So how do you create an account for it? We create an account with his name. Artificial person is a person which is not a natural person. It is an artificial entity in the eyes of law. For example, a company or an organization, a trust. Okay. Representative persons are the persons who are representing a group of people or a group of organizations. So that are or a group of it can be a group or it can be representation of uh, some entity. So that is representative person. The second type of accounts we have are real accounts. Real accounts are the accounts which are for the recording of transactions related to resources or property of a firm. But basically we say they focus on the assets which can be touched or which can be viewed. That is what we call as real account. So they can be real assets, they can be tangible assets, intangible assets. So that is a real account. Now the third one is the nominal account. In this, nominal accounts are all the accounts that focus on the incomes and expenses. So that means whenever we have transactions that focus on the recording of all type of expenses or incomes, then we focus on then we call that account as a nominal account. The example for this is rent account or interest received account. Whereas in previous case, give me a minute, please. Excuse me, just a minute. Okay, so we were talking about real account. Real account. I wanted to example of real account can be, what can be possible example of real account? Furniture, plant. Okay, any sort of property. They are all examples of real account. When we move further to nominal accounts, we are focusing on the incomes and expenses. Expenses are rent. You have paid the rent. You have paid salaries. Salaries is an expense. Whereas in case of income, it can be interest, it can be any sort of other income. That is being. What is sales? Is it an income? Okay. Now, for all of these three accounts, we have few rules which are to be followed in order to record the transactions. The rules for these are, when it is a personal account, what do we do? Where we have three basic accounting rules for recording on the basis of accounts. We have discussed accounting equation, and just to add to that review, I will discuss once more. But for personal account, the rule that we follow is, what is the rule? Anyone? Debit the receiver, credit the giver. Okay. And for real account, debit what comes in, credit what goes out. Considering that this financial accounting as your first interaction with the accounting subject, I would like to recall you here that every transaction is recorded on the basis of double entry system. When we talk about double entry system, we are referring that for every transaction, we'll be recording two aspects of the transaction. So there is a transaction, and we'll have two aspects of that transaction. One is the debit one, another one is the credit one. When I talk about the debit aspect, then what is debit or what is credit? The words have literally no meaning. What we tell them is, when we prepare an account on the basis of T shape of an account, the aspect which is written on the left hand side of the account is the debit aspect, whereas on the other hand is the credit. Similarly, a transaction when recorded on the basis of double entry system holds two aspects, the debit aspect and the credit aspect. So it will be impacting two accounts, one account or the same two accounts. One will have a debit effect, another will have a credit effect. Now, which account will have a debit effect or a credit effect, we can determine this through two ways. The first way is you identify the type of account and you follow the accounting rule. Three basic golden rules, that's what we call them. The other way is you identify the accounts and you follow the accounting equation aspects, and that's how you can identify whether you will debit it or you will credit it. So in this session, we'll be focusing on the accounting rules. So we have discussed the personal account, that is debit the receiver and credit the giver. Whereas in case of real account, we say that debit what comes in, credit what goes out. For example, let's say the examples are on the way, but let's discuss that you purchase furniture on cash. Now, here we have two accounts. One is a furniture account, another one is a cash account. What is the type of furniture account? Furniture account is a real account. What is cash? Cash is also a real account. So we have two real accounts. So now we can follow this rule, debit what comes in and credit goes out, and identify which one we would take as a debit and which one we would take as a credit. Now furniture is a real account. You consider the debit aspect of this. What would you say? What debit what comes in? So furniture is something that is getting added to the business. So we will debit the furniture. Credit what goes out. Cash is the real account that is getting reduced or is going out of the business. So we will credit this. So our journal entry for this would be very simple. Furniture account debit to cash account credit. That's how we'll pass. Let's move on to the other, that is the nominal account. Now, nominal account is account that is related to expenses and income of a firm. So expenses can be anything, it can be, but the expenses here are the business expenses. They are not the personal expenses of the top management, proprietor, owner, or the employees. Okay, so they are the expenses and incomes of the business. Expenses can be rent, can be salaries, can be any sort of expense that business has incurred in order to keep itself running. And income can be anything that is getting generated by the business. It can be interest or it can be anything. Now, example for, so the rule for this nominal account is debit all expenses and credit all incomes. Okay, so the example, for example, you say you rent paid for cash. Rent paid for cash. So here we have two accounts. One is rent, another one is cash. What is rent? Rent is a nominal account. Cash is a real account. So nominal account, the rule we follow is debit all expenses. So we will debit the rent. Cash is real account. Debit what comes in, credit what goes out. So it will have a credit aspect. Also, we suggest that every transaction has two aspects, like it will be influencing two accounts and it would have a double aspect. One is the debit, and equal amount of that would be the flip side, that is the credit aspect. So here the accounting entry would be rent account debited to cash account credited for the amount. Now let's practice few transactions so that we can move further. So the first one is initial investment by the owners, 25 lakh in cash. So now what are the two accounts that we can say or identify here? Can anyone suggest me? We have cash here. The other one is investment by owners. So this is the second one that we can identify. Now if we look here, Investment by owners, what do we call this? We call this as capital. And this is the cash. And this is the amount. Okay. Now identify, what do you say? What is capital? Owners have given it. What is capital? Capital is a liability. One thing. The first thing that should come to your mind is it is a liability. It's a liability or a representative personal account. And then cash is a real account. Plus, the other thing is cash is also an asset. Okay, now let's have a look at from the 3 golden rules, and then we will look the same transaction from the perspective of accounting equation. So what do we do? Debit what comes in. So cash will be cash account debited. Credit what goes out. So cash is coming in, so we debit, and we are creating a liability of capital. So we will credit it. What would we say? Debit the receiver, credit the account with an amount of 25 lakhs. Okay, so you need to write complete 25 lakhs in numbers. So that is what we follow when we follow the 3 accounting rules. But what about the accounting equation aspect? Let's not forget that and take an opportunity to discuss that at the same time. Accounting equation says assets is equal to liabilities plus capital. This is what an accounting equation states. So whenever this is an accounting equation, now we need to expand this. What is this transaction saying? Initial investment by owners 25 lakhs or in cash. So cash comes under asset. So you have a cash. So you have a capital, that is a liability that gets another is capital. We know this. So cash is increased by 25 lakh on one side, and capital is also increased. The liability is increased. Liabilities always have a credit balance. They have a credit balance, and assets have debit balance. So same amount of credit is created here. So if we look into this thing, we can see that it has been cash is equal to the liability. So assets are equal to the liabilities, and we can pass a journal entry through an accounting equation as well. Now the next one is paid cash to creditors rupees 14,000. So now what are the 2 accounts that are getting involved here? The first one is the cash. The second one is the creditors. So we can identify 2 accounts over here. The first is cash, the second is creditor. So now tell me, what is the amount of which account we would get debit and we would credit? So cash is paid. So debit what comes in, credit what goes out. So cash is going out, so we would credit the cash. Creditors are who? They are personal accounts, okay? They can be a debtor and creditor. I hope you have an understanding of what do we mean by a debtor and what do we mean by a creditor. Debtor is somebody who is supposed to give money to the business because the business has made sales to him on credit. He is a customer whom we made credit sales. So he's a debtor. Creditor is somebody to whom the business needs to pay because we have taken some sort of supplies or services from him on credit. So he is a supplier from whom we have taken goods on credit. So that's a creditor. So debit the receiver, credit the giver. Who is a creditor? Creditor, debit the receiver and credit the giver. Who is a creditor? Paid cash to creditor. So creditor is the one who is receiving the cash here. So we will debit it. So what would we do? With the amount of If you need to look at this from the same perspective of accounting equation, what would you do? We continue. We would reduce the cash with 14 lakh. And on the other hand, what would we do? We would reduce the creditors with the same amount of 14 lakhs. Now let's practice, analyze the following transactions. This is for you, can do this. Let's spend a minute over here and do this in a very fast manner if we can. So let's identify the accounts here. Started business with capital of 50,000. So when you see this thing, so there is a capital that is a liability account getting created. When you start business with this, it is implicit in this statement that a cash has been brought into. So what is the entry? Cash account to capital account. Cash account debit to capital account. Now wages and salaries paid for rupees 50,000. Wages and salaries have been paid. If they would have paid from bank, it would have indicated wages and salaries paid on account or by bank, but nothing has been mentioned. So we assume that the wages and salaries have been paid in cash. So what would be the entry here? The first account that we identify is wages and salaries. The second one is cash. Wages and salaries are an expense of business. So the rule says that debit all expenses and credit all incomes. Cash is a real account which is going out. So what would be your journal entry for the same? So we were supposed to journal entry for the same. Wages and salaries paid for. So it is the wages and salaries is a nominal account. It is a real account. Okay. And it is being paid. So we will debit wages and salaries, and cash will be creditors because it is what is going out. It is getting reduced. Also, whenever an asset, here it would be good to mention that we have assets, we have liabilities. If an asset is increasing, it will have a debit balance. If an asset is decreasing, it will have a credit balance. On the other hand, if it's a liability and the liability is increasing, it will have or it will indicate a credit balance. If the liability is decreasing, it will indicate a credit debit balance. Similarly with the capital. Now the rent received rupees 2 lakh. So we have two accounts here again. Rent received in cash. Rent is an expense. It's a nominal account. It is being received. So it's an income. Okay, it's an income here. It's not an expense. It's an income. Okay, and cash is a real account which is getting received. So it is coming in. Debit what comes in, credit what goes out, and debit all expenses and credit all incomes. So what will be the entry here? It would be cash account debit to rent received. That would be credit. Purchased goods on credit. So now goods have been purchased on credit for rupees 9 lakh. What would be the entry here? So goods have been purchased. So goods are the real account that are purchases. They are coming in. On credit means you are creating a creditor. So now here we have two accounts. One is purchases account. Another one is a creditor account. Purchases is the real account. So goods are coming in. So purchases account debit to creditors account with an amount of 9 lakh. Next one is sold goods for 8,16,000 and received payments in check. So you go sold goods. Sold goods means sales is taking place. So income is getting generated. So you will credit the sales and received payment in check. That means there is a bank account is created. Bank account. How do we consider the bank account? We take it as a real account. So you will debit the bank account and credit the sales. So bank account debit to sales account. This is the transaction how you were supposed to look into. So the modern classification of that takes us from our traditional discussion to the modern classification. So traditional classification of accounts says there are three types of accounts: real, personal, nominal. For real account, the rule is debit what comes in, credit what goes out. For personal account, the rule is debit the receiver, credit the giver. For nominal accounts, the rule is debit the expenses and credit the incomes. Whereas the modern classification of accounts says that you can classify accounts into asset account, liability account, capital account, revenue account, expenditure account, and withdrawal account. When we talk about asset account, all assets normally have a debit balance, liabilities have a credit balance. You should have, if you are a first-time student of an account, then you should have understanding of this thing that assets have debit